Look at this chart. Gartner is just, I mean, it's surging right now. It's sitting at $166.18, and that is a massive gap up of over 6.6% from the prior close.
Yeah, and if you zoom out just a bit, over the last 5 days, we are seeing a nearly 18% upward violent reversal, like a total shift in momentum.
Welcome to Market Pulse Daily. Today, you are getting a front row seat to a really bizarre market anomaly with Gartner. But before we get into it, just a quick reminder to check out the special 14-day trial link below in the description for StockOracle.
Right, so StockOracle, if you don't know, it's an AI-aided stock research platform. It is fantastic for pulling fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
Exactly, and we always have to mention, StockOracle is not financial advice, it's not a buy or sell recommendation, and it is definitely not a trading signal service or real-time market data.
Right, and just keep in mind that AI insights and valuation estimates, they can be incomplete or wrong, data might be delayed, so always verify important facts yourself.
Yep, do your own homework. Also, that link down there is an affiliate link, so the channel may earn a commission at no extra cost to you.
Okay, so getting back to Gartner, they lost more than half their value over the last year, down about 55% before this crazy bounce.
Which is just wild when you consider their moat. I mean, they are the undisputed kingmaker of enterprise tech.
Oh, for sure. Fortress is probably the best way to describe their business model. They operate as a research and advisory firm, right? But their real leverage comes from two very specific proprietary frameworks.
Right, peer insights and the big one, the Magic Quadrant.
Exactly, the crown jewel. If you are an enterprise IT vendor and you are trying to sell software to major corporations, you are basically required to engage with Gartner's analysts. You have to try and get that leader status in the Magic Quadrant.
Let's mechanically break down why that is so powerful, because it is literally the engine of their revenue. I look at it like a lot like the FDA for pharmaceuticals, right? Or maybe the Michelin Guide for high-end dining.
That's a great comparison.
Yeah, because to get FDA approval, a drug company has to go through years of rigorous clinical trials. The Magic Quadrant is the clinical trial for tech vendors. Gartner's analysts spend months evaluating a product, the financials, customer service.
Long vision, all of it.
Right. Yep. And if you make it into that top right leader quadrant, you pass the trial. You have the stamp of approval.
And that rigorous methodology, that's what corporate buyers are actually paying for. They are buying risk mitigation.
Yep.
Imagine you're a chief information officer, a CIO, and you decide to just wing it and buy $50 million of unvetted software.
Oh, man. Bad idea.
Right. If that software implementation fails, it disrupts the entire company, and that CIO is almost certainly getting fired for negligence.
But if that same CIO buys software that Gartner named a leader and the software fails...
But they have an insurance policy. They can just point to the Gartner report and say, hey, I followed the gold standard of industry advice. It's not my fault.
Exactly. The old saying was, nobody ever got fired for buying IBM. Today, nobody gets fired for buying what Gartner recommends. Corporations simply will not make major technology investments without that validation.
And we actually see this kingmaker effect playing out in real time in the current market data. Recently, companies like Freshworks and Intervaxer were named leaders in their respective quadrants.
And the market reaction was instantaneous, right?
Totally. Investors read those designations as highly bullish for those specific vendors because they know it just opens the floodgates to corporate purchasing.
Yeah, and our research shows Lumen, their stock, saw a notable bump simply because they got a Gartner endorsement for their AI connectivity solutions. Yeah. Having the power to move another publicly traded company's stock price just by mentioning them, that is a wild level of influence.
It really is. And looking at the financial reports, they have translated that influence into just an absolute cash-generating machine.
Let's space out these numbers to really understand the scale here. In the second quarter of calendar year 2025, Gartner's revenues hit $1.69 billion.
Wow.
Yeah, up 5.7% year over year, which matched Wall Street's expectations. And on a trailing 12-month basis, their revenue is sitting at a massive $6.42 billion.
But the top-line revenue isn't even the craziest part of their fundamentals. The margins are where you see the sheer scalability of this business. We are looking at a trailing gross margin of nearly 69%.
Let's pause on that. 69% gross margin, because that explains the mechanics of their cash flow. Unlike, say, a manufacturer that has to buy steel and glass to build every single new car.
Right, physical goods.
Yeah, Gartner's primary product is intellectual property. They pay an analyst to write a highly detailed research report once, And then they can sell digital access to that exact same report to 10,000 different corporate clients at a huge premium.
The cost of delivering that second or thousandth copy is essentially zero,
Yeah,
which flows directly down to their operational profitability. Their adjusted EBITDA for Q2 2025 was $443 million.
that's incredible.
Yeah, and that equates to a 26.3% margin. Plus, their free cash flow margin remains incredibly robust at 20.6%.
So they're just swimming in cash. And the obvious question is, what are they doing with it? The balance sheet data shows they are maintaining a very stable posture. They recently divested their digital markets business just to, streamline operations.
Focus on their core advisory strengths, yeah.
Right. But the really aggressive move is how they are returning capital. In 2025, they repurchased $2 billion of their own stock.
That is a staggering capital allocation decision. They also completed their first investment-grade bond issuance recently, which effectively lowers their overall cost of capital.
Gives them tons of liquidity.
Exactly.
Just to put that $2 billion buyback into perspective, we are looking at a company with a current market cap of around $10.4 billion. Buying back $2 billion means management just stepped into the open market and retired nearly 20% of the entire company's outstanding float.
That isn't just a routine buyback. That is management screaming that they believe their stock is absurdly cheap.
Which brings us to the cognitive dissonance at the center of all this data. How does a company with an impenetrable moat, 69% gross margins, and billions in cash flow suddenly lose more than half of its value?
Well, the catalyst for the crash comes down to the one thing Wall Street simply will not tolerate in the tech sector.
Let me guess. Growth deceleration.
Bingo. The bear case firmly took hold because Gartner's organic growth hit the brakes. By the fourth quarter of 2025, year-over-year revenue growth dropped to a meager 2.2%.
Ouch.
Yeah. Concurrently, we saw their profit margins begin to slide just slightly.
I mean, a 2.2% growth rate for a premium tech advisory firm is definitely a red flag. But the punishment they took seems completely disconnected from reality. The stock plummeted 53.5% from its 52-week high of $357.33.
It was a brutal repricing event. Because of that drawdown, Gartner's valuation ratios collapsed. And this is the critical metric that caught the attention of institutional buyers. Their trailing price-to-earnings ratio, the PE, fell to just 14.07.
Wait, I got to interject here. Because a PE of 14 for this specific company is a massive anomaly. The S&P 500 average usually hovers around, what, a 20 to 25 PE?
Yeah, right around there.
And a tech company with monopoly-like characteristics usually trades in the 30s or 40s. A PE of 14 isn't just the market saying, hey, your growth slowed down. A PE of 14 is the market pricing in terminal decline.
Oh, absolutely. They were valuing Gartner like a dying brick-and-mortar retail chain. Wall Street wasn't just disappointed, they were terrified of total obsolescence.
And that terror was driven by generative AI, right?
Exactly. The primary existential threat disrupting the entire knowledge economy. The market looked at tools like ChatGPT and Claude and formed a very deadly bear thesis. The fear was that corporate IT departments would stop paying millions for Gartner contract renewals because they could just self-serve their advisory needs using AI.
Honestly, I'm going to push back on the bullish view for a second because that bear thesis makes a lot of intuitive sense. If I am a CIO and I'm under pressure to cut my budget, why wouldn't I cancel my subscription?
I mean, it sounds logical.
Right. ChatGPT has scraped every tech manual, every user review, every integration guide on the public internet. I can just ask the AI which supply chain software is best for my industry, and I get an instant free answer.
The logic tracks on the surface, and that is exactly why investors dumped at the stock. But the flaw in that thesis is the fundamental difference between raw information and validated governance. Yes, an AI can instantly generate a list of popular software, but it cannot guarantee that the software complies with strict European data privacy laws.
True.
It can't seamlessly map out how that new software will interact with a company's 15-year-old legacy database.
But consider this. What happens when Microsoft or OpenAI inevitably offer enterprise indemnification? What if they say, use our AI for your procurement, and if it hallucinates or gives you bad advice, we will legally cover the financial losses? Doesn't that instantly evaporate Gartner's moat?
That is the ultimate nightmare scenario for advisory firms, but it fundamentally misunderstands the implementation gap. Financial indemnification solves the legal liability, sure, but it does not solve the operational catastrophe of a failed integration.
Ah, okay. I see where you're going.
Right. If an AI hallucinates and recommends an incompatible architecture, the company's servers still crash, supply chains still halt, and that CIO still gets fired. Regardless of who writes the check for the damages later, Gartner's analysts actually map out those specific architectural nightmare scenarios, which general AI simply cannot do without proprietary access to internal systems.
Which perfectly sets up Gartner's counteroffensive. The market reports show they aren't just sitting there letting AI commoditize them, they are actively pivoting. They're launching a tool called Ask Gartner. It's an AI-powered interface, but the mechanics of how it works are crucial.
The underlying technology relies on a mechanism called retrieval augmented generation, or ARAS.
ARAS.
Instead of the AI scraping the open internet, where it can pick up marketing spin or just outdated junk, Ask Gartner is mathematically restricted. It can only query Gartner's proprietary, highly voted, walled-off research vault.
So they are taking the threat, the AI chat interface, and turning it into a feature to deliver their own premium intellectual property.
Exactly.
But the data shows this story is much bigger than just Gartner updating its search bar. The macro environment they're operating in is exploding. Gartner recently raised its global IT spending forecast for 2026 to a staggering $6.37 trillion.
That is a 14.2% increase.
Driven almost entirely by explosive corporate demand for AI infrastructure.
And the internal metrics within that forecast are where the bear thesis truly begins to unravel. The AI platforms market itself is forecast to grow 63.4% to $64.25 billion in 2026. And a specific subsector known as domain-specific language models, or DSLMs, is projected to grow by an astonishing 210%.
Let's clarify what a DSLM is for anyone not deep in the engineering weeds. This isn't a general chat bot that writes poetry and code. A domain-specific language model is an AI trained solely on a highly specialized data set.
Like a bespoke AI built just to analyze legal contracts or diagnose medical imaging?
Right. They are incredibly complex, very expensive, and completely untested at scale. And that specific market is growing at 210%.
The sheer complexity of that growth rate is the catalyst for Gartner's survival. When tech evolves slowly, a company might feel confident navigating procurement without an expensive advisor. But when highly specialized, experimental AI models are flooding the market at a 210% growth rate, flying blind is corporate suicide.
Yeah, you'd be crazy.
The new market thesis, the one driving this massive current rebound, is that corporations are going to be forced to rely on Gartner's human-validated advisory services even more just to survive the chaos of this AI supercycle.
That structural shift completely changes the narrative. We have a deeply discounted valuation, a misunderstood moat, and a massive macro tailwind. And looking at the live market sentiment, the institutional money has aggressively caught on.
Like we said at the start, a near 18% jump in a single week on heavy volume is a classic signature of a fundamental re-rating.
Yeah.
It suggests a catalyst-driven influx of institutional buying, potentially squeezing out the short sellers who were betting on that obsolescence narrative.
But the most compelling signal in this entire data stack isn't coming from the algorithms. It is coming from human behavior. The insider flow over the last 90 days is overwhelmingly bullish. We're looking at 49 buy transactions from insiders versus just 22 sells.
That nets out to 19,742 shares purchased directly by the people running the company.
Right. Insider cluster buying at 52-week lows is a uniquely powerful quantitative signal. The data tracks a metric called the Insider Market Sentiment Probability Rank, or MSPR. Right now, Gartner's MSPR is strongly positive at 51.91.
Which indicates broad, coordinated conviction among executives that the market has fundamentally mispriced their equity.
It's the ultimate put your money where your mouth is indicator. An executive can go on an earnings call and spin a great story. But when multiple executives open their personal brokerage accounts and aggressively buy the dip at the exact moment Wall Street is panicking, that tells you they see inherent value the public is missing.
And the quantitative valuation models are confirming that value. Our research points to a fair value target of $283.73. With the stock currently trading around $166, that fair value model suggests the equity is nearly 39.7% undervalued today.
That fear of AI disruption has created a massive margin of safety for investors willing to look past the short-term growth deceleration. And the data suggests we might see an acceleration sooner rather than later, driven by some fascinating speculative catalysts bubbling under the surface.
Oh, the M&A chatter.
Yes. There is unconfirmed chatter suggesting Gartner is actively exploring strategic M&A mergers and acquisitions, specifically targeting the AI governance tooling space.
That strategic pivot would be brilliant. Right now, Gartner advises companies on which AI to buy. If they acquire the software platforms that actually monitor AI performance, track data leakage, and enforce corporate compliance policies in real time.
Their business model fundamentally evolves. They stop being just the trusted advisor and become the actual daily regulator. They become the toll booth for managing enterprise AI long-term.
Deeply embedded in the daily operations of their clients. So, looking at the calendar, what is the immediate test for this new bullish thesis? Earnings are expected next week in early August 2026.
That upcoming earnings call is the defining moment. CEO Gene Hall has previously guided that contract value, or CV, will accelerate throughout 2026. Contract value is the critical metric here because it doesn't just look at past sales, it measures the guaranteed recurring revenue locked in for the future via client subscriptions.
If management can get on that call and prove that the Ask Gartner tool is successfully defending their renewal rates against the AI threat and simultaneously demonstrate that contract value is indeed accelerating as guided, that is the spark.
Because despite the recent 2.2% slowdown, the Street consensus still expects 5.6% revenue growth over the next 12 months. If they beat that, the 14 PE ratio is going to correct violently upward.
And that's the upside case. The overall investment data yields a bullish score of 8 out of 10. The tactical setup points to a swing trade heading into these August earnings, which, given the macro tailwinds in IT spending, easily transitions into a multi-year hold.
But we have to lay out the downside risks, too.
Of course, the risks are clearly defined. If Ask Gartner fails to resonate, or if organic growth slips below that 2% mark, the stock could just languish. But a lot of those risks appear overwhelmingly priced into that deeply discounted multiple.
Pulling all of this together, Gartner, the absolute gatekeeper of the enterprise tech world, survived a brutal 55% drawdown. Wall Street panicked, convinced that AI chatbots would commoditize human advisory services, driving the valuation down to levels normally reserved for dying industries.
However, with massive insider cluster buying, the rollout of their proprietary RG-based AI tools, and a massive $6.37 trillion macro tailwind in global IT spending, the market is aggressively waking up to the mispricing.
It is a phenomenal masterclass in corporate resilience. The companies that survive technological revolutions do not try to fight the new technology. They adopt the very thing threatening them, integrate it into their workflow, and use it to reinforce the walls of their existing moats.
Perfectly said.
And before we sign off, don't forget to check out the special 14-day trial link for StockOracle in the description. Like we mentioned, it's an AI-aided platform for fundamentals, valuation estimates, and portfolio research. It is not financial advice, and you should always verify the AI insights. That is an affiliate link. Also, make sure you hit that subscribe button for more Market Pulse daily updates.
And just to leave you with a final thought to mull over, think back to that FAA certification for the private jet we talked about earlier. We are entering an era where AI is making raw information infinitely abundant, completely free, and instantly accessible. As that happens, the market value of raw data will inevitably drop towards zero. But if information is infinite and free, does the premium for trusted, heavily vetted, human-validated authority like a Gartner stamp of approval actually skyrocket?
Because in a world completely drowning in free answers, knowing which answer is actually safe to bet your career on might become the most valuable commodity of all, something to keep an eye on. Until next time, keep digging.